events playing out at MF Global make a, quote, crystal clear case for stronger regulation and the implementation of the Volcker Rule. That's according to Andrew Stoltmann, a securities lawyer who represents investors in lawsuits against banks and brokerage firms. And he joins me now from Chicago. Andrew, welcome back to Bottom Line. Always a pleasure to have you on.
Thank you.
Andrew, this breaking news that we were just talking about just moments ago, the Associated Press reporting that a federal official is saying that someone at MF Global was saying that perhaps clients' money was being used in some of these transactions. I was wondering if I could get your thoughts on that first.
Boy, absolutely stunning. I mean, we all knew it was bad, but I think this introduces a criminal element to it that not many of us expected. So all I hope is that some of the higher-ups at MF Global have retained very, very good legal counsel, because now it's not just a regulatory probe. There's no question that there's going to be a criminal probe.
Well, take us through the steps. By criminal probe, what do you mean?
Well, I think you're going to have the criminal investigators in there peeling the onion, looking for money that may have been converted, money that may have been commingled. Who knows what they're going to find? And obviously none of us know at this point, but it's a very, very bad development for the company and the senior executives.
Andrew, why wasn't MF Global considered to be a systemically important financial institution? It seemed to fly under the radar.
You know, there's no question that it did fly under the radar, and, you know, I think we can see with the impact that it's had on the markets in the last couple of days that, you know, I think now you have a lot of these banks, brokerage firms, hedge funds so intertwined with the global economy that I don't know if you can say an outfit like MF Global isn't systemically important in terms of its risk to the rest of the world.
Andrew, on the New York Times website today, Claire Hill and Richard Painter wrote the following, and we'll put it up on our screen. Making bankers pay for their own excessive risks will be a lot easier and more effective than using complex rules as the Volcker Rule. They continued, changing incentives rather than expanding regulation is the best way to control the risks bankers take with other people's money. Are they right? If you hit bankers in the wallet, is that a more effective strategy?
Well, you know, it probably is more effective, but I think it works in tandem with the Volcker Rule. Don't even give them an opportunity to gamble with the firm's money and other people's money, because we know from what happened in 2008, and MF Global is the latest example, that when it comes to big banks, brokerage firms, it's tough for us to trust them. And fortunately, this did happen to a smaller firm and not a Goldman Sachs or not a Morgan Stanley, but I think we see the same problems today that we saw in September of 2008.
The Glass-Steagall Act, that was repealed in the 90s. It effectively put up a firewall between investment banks and commercial banks. The rules were clear. Does the Volcker Rule as written have that clarity?
Yeah, well, you know, what's interesting right now is the Volcker Rule is being debated amongst multiple regulatory entities, and the devil is in the details, so it hasn't taken its final form. But we know that the securities industry is ferociously lobbying to try to water down the Volcker Rule, to try to create as many exceptions as possible, and that's why what happened with respect to MF Global and also what happened with respect to the UBS trader who caused that $2.3 billion trading loss is so important. It couldn't have happened at a worse time, because it's given ammunition to those of us who are saying the Volcker Rule needs to be strengthened. It's given great ammunition to those folks.
And one of those folks, Bloomberg View columnist Bill Cohen, he's the author of Money and Power, How Goldman Sachs Came to Rule the World. He was on with my colleague Pim Fox yesterday, and he said that John Corzine told him that MF Global was, in Bill's words, a relatively staid, not risk-oriented firm, and that he, Corzine, needed to ratchet up the risk. Should John Corzine, who ran Goldman during the mid-90s, have known better?
Absolutely no question. He had MF Global leveraged to an 80-to-1 debt-to-capital ratio. Even Lehman Brothers in September of 2008 was leveraged only 45-to-1. So he knew exactly what he was doing. Published reports have also said that he didn't hedge any of those positions, which in my opinion is inexcusable. So should he have known better as the gentleman who used to run Goldman Sachs? Absolutely.
What recourse do MF Global's clients have? Is their money gone for good?
No. The good news is I think if their money is there, then SIPC will protect it. They will be able to transfer the money out. It's probably frozen at this point.
Well, I'm sorry, but we're also running a story that some folks they're actually calling SIPC and saying, what do I do? And they're telling them basically keep your receipts, keep your canceled checks, keep any piece of information you can to let us know how much money you may have lost.
Yeah, no question about that. And if money was stolen, depending on who stole it, that can go into the equation. Some of that money might be gone. Hopefully it's still there, but it is a complete mess. If I had my money there, I'd be nervous, but hopefully it's going to work out for the best.
Andrew, we have about a minute left. What are the lessons to be learned from the MF Global bankruptcy, and what type of scrutiny are other primary government securities dealers now going to be under?
Well, this just could not have happened at a worse time, given that so many components of Dodd-Frank are still up for debate right now. This really has reminded us that, not much has changed since September of 2008. We still have banks, brokerage firms, hedge funds that can take extreme risks, leveraged, 80-to-1 debt-to-capital ratios, and, that introduces a level of systemic risk that is really problematic for this, not just our country, but for the global worldwide economy. And it's frightening that more than 3 years after September of 08, it seems like not much has changed.
So then basically what you're telling me very quickly is that no lesson has been learned.
It appears not. I mean, it seems like every 5 to 10 years we have to learn these sorts of lessons all over again. It's been happening for a long time, and so far, nothing's changed. Andrew
Stoltmann, a securities lawyer. He represents investors in lawsuits against banks and brokerage firms, joining us from Chicago. Andrew, it's always a pleasure. Thanks so much.
Thank you.